What if your money could work for you 24 hours a day, 7 days a week, even while you sleep? Real estate investing has built more millionaires than almost any other asset class. But most people never start because they think it requires a fortune up front. Today we break down everything, from rental yields and cap rates to REITs, leverage, and when appreciation beats cash flow. At its core, real estate investing means buying property to generate income or profit. There are two main ways to win: cash flow and appreciation. Cash flow is the monthly rent minus all your expenses, mortgage, taxes, insurance, maintenance. Appreciation is the property gaining value over time. The best investments deliver both. A property that cash flows positively and appreciates is the holy grail. Rental yield tells you how efficiently a property generates income. Gross rental yield is annual rent divided by property price times 100. So a house bought for $400,000 renting for $2,000 per month has a gross yield of 6%. Net yield subtracts expenses, typically reducing yield by 2 to 3%. Markets like the U.S. Midwest, parts of Texas, and Southeast Asia consistently offer higher net yields than coastal cities. Cap rate, capitalization rate, is how professional investors value income properties. It equals net operating income divided by property value. A property generating $30,000 per year in net operating income worth $500,000 has a 6% cap rate. Higher cap rates mean higher returns, but often higher risk. Think less desirable neighborhoods or older buildings. Lower cap rates signal premium locations with stable demand. Most institutional investors target 4 to 8%. Leverage is real estate's superpower. With a 20% down payment, you control 100% of a property. If that property rises 10% in value, you've made 50% on your actual cash invested. But leverage cuts both ways. A 10% price drop wipes out half your equity. That's why cash flow matters so much. Positive monthly income lets you ride out downturns without being forced to sell at a loss. Don't have hundreds of thousands to buy property? REITs, real estate investment trusts, let you invest in real estate with as little as $1. REITs own and operate income-producing properties, shopping centers, apartments, warehouses, hospitals. By law, they must pay out 90% of taxable income as dividends. This creates reliable income streams. REITs trade like stocks, so you get real estate exposure with stock market liquidity, the best of both worlds. Direct ownership versus REITs. Which wins? Direct property gives you control, tax benefits like depreciation write-offs, and the ability to force appreciation through renovations. But it requires significant capital, active management, and carries concentration risk. REITs offer instant diversification across dozens of properties, professional management, and daily liquidity. The answer depends on your capital, time, and risk tolerance. Many sophisticated investors hold both: direct property for control and tax efficiency, REITs for liquidity and diversification. Real estate investing rewards patience and education. Start by understanding your local market, calculating cap rates on every deal, and never over-leveraging. Whether you buy your first rental property, invest in REITs, or both, the key is starting. Every day you wait is a day you miss compounding returns. Run the numbers, build your knowledge, and take that first step. Your future self will thank you.